You worked your whole life in Canada. You paid your taxes, raised your family, and now you're retired. And maybe, just maybe, you've been thinking about spending your later years somewhere warmer, somewhere cheaper, somewhere closer to family who moved abroad years ago. It sounds like a dream, and for many Canadian seniors, it genuinely is. But here's where it gets complicated, because the moment you leave Canada, whether you're gone for 6 months or 6 years, the government benefits you've been counting on every month do not automatically follow you out the door unchanged. Some benefits continue, some get reduced, and one, in particular, can stop completely the moment you land in another country. If you receive OAS, that's Old Age Security, or GIS, the Guaranteed Income Supplement, this video is specifically for you. Because in 2026, with more seniors considering international moves to reduce their cost of living, these rules matter more than ever. And most people don't find out about them until after they've already made the move. So let's go through this carefully and clearly. No panic, no rushing. Just the rules as they exist, explained in plain language, so you can make the right decision for yourself and your family. Let's start with the basics, because not everyone watching this has the same situation, and I want to make sure we're all on the same page before we get into what changes and what doesn't. Old Age Security, or OAS, is a monthly payment from the Government of Canada. You qualify for it based on how long you lived in Canada as an adult, not based on how much you worked or how much you earned. Most Canadians who have lived here for at least 10 years after the age of 18 receive some amount of OAS. If you've lived here for 40 years as an adult, you receive the full amount. The Guaranteed Income Supplement, GIS, is different. GIS is an additional monthly payment that goes on top of OAS, but it's only for lower-income seniors. Your eligibility for GIS is based on your income from the previous year. It is income-tested, meaning the less income you have, the more GIS you may receive. And if your income goes above a certain threshold, your GIS reduces or stops entirely. Now, both of these programs are administered by Service Canada, which is the branch of the federal government that handles senior benefits. They operate under specific rules about residency, and those rules are the heart of what we're talking about today. So here's where things start to matter. Let's talk about what happens when you leave Canada. With OAS, the situation depends entirely on two things. First, how long you lived in Canada as an adult, and second, which country you're moving to. If you have lived in Canada for at least 20 years after the age of 18, you can receive your OAS payment outside of Canada indefinitely. That's the rule. 20 years of Canadian residency after age 18 means your OAS follows you wherever you go in the world. It will be deposited to your Canadian bank account, or it can be sent internationally if you set that up with Service Canada. However, and this is where many people are caught off guard, if you have fewer than 20 years of Canadian residency after age 18, your OAS payments will stop after you have been outside of Canada for more than 6 months. 6 months is the threshold. Once you've been gone longer than that, and you don't meet that 20-year mark, the payments stop until you return and re-establish residency. Now, there's an additional layer here. Canada has what are called Social Security Agreements with certain countries. These are official agreements between Canada and another government that allow your years of residency or contributions in that country to count alongside your Canadian years when determining benefit eligibility. Countries like the United Kingdom, Italy, the Philippines, Portugal, Greece, and many others have these agreements in place. If you're moving to one of those countries, the rules may work differently in your favor, but you need to confirm this directly with Service Canada before you move, because these agreements are country-specific and the details matter. Now, let's talk about GIS, because this is the one that surprises people the most. And honestly, it's the one I want you to pay the closest attention to. GIS is not payable outside of Canada. Full stop. That is the official rule from the Government of Canada. The moment you leave Canada, and you are no longer considered a Canadian resident for the purposes of this benefit, your GIS stops. And it doesn't just pause, it stops. And restarting it when you come back requires going through the application process again and waiting for it to be recalculated. This is a significant issue for lower-income seniors because GIS can be several $100s a month. For some seniors, it represents a meaningful portion of their total monthly income. If you are receiving GIS, and you are planning to move abroad permanently, you need to understand that this income will not be coming with you. Now, what about temporary travel? Let's say you're not moving permanently, but you want to spend the winter in another country. Maybe you want to go to Portugal for 4 months, or visit family in the Philippines for 5 months. For most people, a short absence from Canada, under 6 months, does not automatically trigger a loss of GIS, but the key word there is resident. The government looks at whether you remain a Canadian resident. It's not purely about the number of days. If you sell your home in Canada, close your bank accounts, move your belongings to another country, and apply for residency there, the government may consider you to have left Canada even if you haven't been gone a full 6 months. The residency determination is based on your ties to Canada. Do you still have a home here, a bank account, provincial health coverage, family? The stronger your ties to Canada, the more likely you are to be considered a resident even during extended travel. This is why I always encourage people in your situation to speak with Service Canada directly before making any major decisions. Not after, before. Let me give you a real-life example to make this concrete. Let's say her name is Margaret. Margaret is 73 years old. She lives in Hamilton, Ontario. She receives her full OAS, let's say around $710 per month. She also receives GIS because her income is modest. She gets about $450 in GIS each month. That's roughly $1,160 a month from these 2 programs alone, not counting whatever small CPP she might have. Margaret's daughter moved to the Philippines 15 years ago and has a family there. Margaret is tired of the Canadian winters. Her cost of living is getting harder to manage, and she wants to spend her remaining years near her grandchildren. She decides to sell her condo, pack her belongings, and move. What happens? Margaret has lived in Canada for her entire life, well over 20 years after age 18, so her OAS is safe. It will continue. She may need to set up an international direct deposit, and there may be a non-resident withholding tax applied to her OAS. We'll come back to that in a moment. But the OAS itself doesn't stop. But her GIS, that stops, because she is no longer a Canadian resident. that $450 a month is gone. And because her income abroad may be low, she might find herself in a difficult position financially if she hadn't planned for this. If Margaret had known this in advance, she might have made a different plan. Maybe she would have kept her apartment, rented it out, and traveled for several months at a time rather than moving permanently. Maybe she would have structured things differently. The point is, the information matters before the decision, not after. Now let me talk about that withholding tax I mentioned, because it comes up for almost every senior who moves abroad. When you become a non-resident of Canada for tax purposes, the Canadian government still taxes your OAS, but instead of you filing a full Canadian tax return each year, they apply what's called a non-resident withholding tax directly to your OAS payment. The standard rate is 25%. So if your OAS is $700 per month, 25%, that's $175, would be withheld before you receive your payment. However, if you move to a country that has a tax treaty with Canada, that rate may be reduced. Many countries have treaties that bring the withholding rate down to 15%. Some treaties have different terms. This is something you would want to confirm with the Canada Revenue Agency, the CRA, and potentially with a cross-border tax professional, because it varies depending on where you're going. The key point here is your OAS deposit abroad will likely be smaller than your OAS deposit in Canada because of this withholding. It's not a penalty, it's a tax, and in some cases, depending on your situation in your new country, you may be able to claim a credit for it or have it reduced through treaty provisions. Let's talk about what you should actually do if you are considering a move, whether it's permanent or long-term. The first thing, before you do anything else, is to contact Service Canada. You can reach them at 1-800-277-9914. Tell them you are considering leaving Canada and ask them specifically how your OAS and GIS would be affected. Ask them whether the country you are moving to has a Social Security agreement with Canada. Ask them what you need to report and when. The second thing is to log into your My Service Canada account. If you don't have one, it's worth setting up. You can find it at canada.ca. From there, you can see your payment history, your current benefit amounts, and any correspondence from Service Canada. When you move abroad, you'll also need to update your address and banking information through this account or by calling them directly. The third thing is to contact the Canada Revenue Agency, the CRA, to notify them that you are changing your residency status. This is a step many people forget, but it matters because your tax situation changes when you leave Canada. You can inform the CRA by completing what's called an NR73 form, a determination of residency status form. This form helps the CRA assess whether you are truly a non-resident. You don't have to complete it, but if there's ever a question about your status, having completed it protects you. The fourth thing is to check your provincial health coverage. Each province has its own rules about how long you can be outside of Canada before your provincial health insurance, your health card, becomes invalid. In Ontario, for example, the limit is typically 212 days per year. In British Columbia, it's different. If you lose your provincial health coverage and something goes wrong medically while you're abroad, you could face significant costs. So this is not just a financial benefits issue, it's a health issue too. Now, let me address some of the most common mistakes I see seniors make when they're thinking about moving abroad. The first mistake is assuming that because OAS continues, everything continues. As we've covered, OAS and GIS are two different programs with two different sets of rules. OAS may continue. GIS will not if you become a non-resident. These are not the same thing, and treating them as though they are is a costly error. The second mistake is not telling Service Canada about the move. Some seniors think they can quietly spend time abroad without notifying anyone and keep collecting everything as normal. This is a problem. If the government determines that you have become a non-resident and you haven't reported it, they may require you to repay benefits that were paid out incorrectly. That can be a large amount of money to pay back, and it causes significant stress. The third mistake is making assumptions about the country you're moving to without checking whether Canada has a social security agreement with that country. Sometimes the agreement helps you. Sometimes it doesn't apply to GIS at all. Most social security agreements specifically relate to OAS eligibility, not to GIS, so you cannot assume that an agreement means GIS is protected. It almost never is. The fourth mistake is waiting until after the move to figure out the tax implications. The non-resident withholding tax can reduce your OAS significantly if you're not prepared for it, and organizing your tax situation takes time. Doing it in advance means you're not scrambling after the fact. Let's talk about what happens to your CPP in all of this, because I know many of you also receive CPP, the Canada Pension Plan. CPP is treated differently from OAS and GIS. CPP is a contributory program. You earned it by working and contributing to it over your career. Because of that, it is payable to you anywhere in the world, regardless of how long you've been outside Canada. Your CPP does not stop because you moved abroad. It follows you. Like OAS, if you become a non-resident, a withholding tax will apply to your CPP payments. Again, the rate depends on where you live and whether a tax treaty is in place. But the payment itself does not stop. So if you are someone who receives CPP, OAS, and GIS, and you move abroad permanently, here is the summary. CPP continues. OAS likely continues if you've lived in Canada for 20+ years as an adult. GIS stops. Looking ahead into 2026 and beyond, there are a few things worth being aware of. OAS amounts are adjusted quarterly in January, April, July, and October, based on changes in the Consumer Price Index, which measures the cost of living. So even if you're abroad, your OAS payment may increase slightly with those adjustments. That's good news. But those adjustments don't bring back GIS if you've left Canada. There is ongoing discussion in Canada about the cost of living challenges facing seniors, and some policy advocates have raised questions about whether GIS rules should be modernized given the realities of aging and international family connections. But as of 2026, the rules remain what they are. GIS is not payable to non-residents. It would be misleading to tell you otherwise. If you are considering a move and your GIS is a significant part of your income, please do the math carefully before you decide. What is the cost of living in the country you're considering? What does your income look like without GIS? Can you sustain yourself comfortably? Or will you be in a more difficult position than you expected? Let me bring this all together, because I know that's a lot to absorb. If you are a Canadian senior thinking about moving abroad, whether it's to be closer to family, to reduce your cost of living, or simply because you've dreamed of it for years, you absolutely can do that. Many Canadian seniors live abroad successfully and happily, but the financial picture needs to be understood clearly before you go. OAS can continue outside of Canada if you've lived here for at least 20 years as an adult, and if you're moving to a country with a social security agreement, that may help with eligibility calculations. GIS stops when you become a non-resident of Canada. That is the rule, and it is important. CPP continues wherever you go in the world. A non-resident withholding tax will apply to your OAS and CPP, and the rate depends on tax treaties with the country you're moving to. Notify Service Canada before you move. Notify the CRA. Check your provincial health coverage rules. Log into My Service Canada account, and make sure your information is up to date. And if your situation is complicated, if you're not sure whether you qualify as a resident or if you have income from multiple countries, consider speaking with someone who specializes in cross-border or non-resident tax situations for Canadians. This is not meant to scare you away from the life you want. It's meant to make sure that when you get there, you're not surprised. Because a surprise in your 70s involving hundreds of dollars less per month is not a small thing. It's something you deserve to know about in advance. Before I close, I'd love to hear from you. Are you currently thinking about spending extended time outside of Canada? Or maybe you've already made a move and you're dealing with some of these benefit questions right now. Leave a comment below and let me know your situation. You might be helping someone else who is in the exact same position and doesn't know where to start. And if this kind of clear, calm information about Canadian senior benefits is helpful to you, please consider subscribing to Retirement Path Canada. We cover OAS, GIS, CPP, and everything in between, in plain language, for real people who just want to understand what they're entitled to and how to protect it. Thank you for watching. Take care of yourself and take care of each other.